Now, if I asked you the question, where does expectancy actually come from for your trading system, what would be your response? Would you say, oh, it relates to the success rate of the system or the risk to reward on individual trades, or even where I choose to enter my trades? Now, these may be considerations at a surface level, but we're actually going to look at the structural level underneath. And I'm now going to introduce a simple example. Now, here we have the same trading system being used across two different time periods, 1 and 2. The success rate for the system during time period 1 is 45%. The average return on profitable trades is 2R. The average loss on losing trades is 1R. And these numbers combine to produce positive expectancy over time period 1. Now, using the same trading system across time period 2, the success rate has dropped to 35%. The average return on profitable trade and the average loss on losing trades are exactly the same as they were during time period 1. However, now these numbers combine to produce negative expectancy. So this shows that the same system can produce both positive and negative expectancy at different time periods. But why the change? Now, you may say, well, that's easy. The success rate has fallen to 35%. However, I'd like to ask a question back. Why has this success rate fallen from 45% to 35%? Therefore, we're going to now look at some other contributing factors. Here you have a structural understanding as to where expectancy is generated from. So, market behaviour produces opportunities, and this is in the form of trends, volatility, and directional movement. As a result of this market behaviour, trading rules are then used to capture some of these opportunities through entries, exits, and filters on your trading system. And these two interact with each other to produce the output of expectancy, which is what we saw for period 1 in the example. However, if the market behaviour changes in period 2, potentially due to market regimes producing different environments and therefore producing different outcome distributions in the form of profitable trades and losing trades, even though you may use the same trading rules, now the interaction between these two produces a different expectancy output, because the same opportunities that existed in period 1 as a result of the market behaviour are not the same as the new opportunities that are presented under period 2. So when looking to get to the root cause of why expectancy is generated, it's important to ask, where is expectancy generated in my system, and which market conditions actually support it. And this helps you to understand when expectancy actually deteriorates over time. Also, asking questions such as which instruments contribute the most expectancy to my trading system, and therefore an understanding of how stable is this expectancy over time. So, based on what we've seen, the goal isn't about just finding the trading system with the most positive expectancy. It's actually about trying to understand where expectancy has emerged from. Because if you understand the origin of expectancy, it helps to understand why expectancy can actually disappear over time and then enable you to adapt during different market conditions. Therefore, if you'd like to learn more about trading expectancy or structural analysis, then I provide additional information in the description below. Thanks for watching today, and I'll see you in the next video. Bye for now.